Accounting software company Xero's shares surged to a record high this week after the Kiwi-based business posted a sharp increase in half-year profit to about 86 million Aussie dollars. Xero added 241,000 subscribers during the half, with average revenue per user growing 15%. Ingrid Willinge caught up with the CEO of Xero, Singh Cassidy.
Well, I think right now, I think what investors are liking is the balance of high growth and profitability. As you know, Xero embarked on that journey to be both a couple of years ago, and so I think continuing to deliver on that promise is quite important. Number two, I think they like that Rule of 40 outcome, so we were able to achieve 43 on the Rule of 40, which is that combination of sort of high growth plus profitability added together. That's a classic SaaS metric. And then three, I think they're seeing that we are delivering on what we said we'd do in accordance with our strategy. So really putting efforts in product, in our acquisition of Sift, right against the things that we talked to them about at Investor Day 6 months ago.
It's interesting, you mentioned that Rule of 40. It's really become something that investors have latched onto. Why do you think that is? I mean, what is it about that metric that is important, the simplicity of that metric that's important for investors?
Well, I think you hit it. It's the simplicity of the metric, right? If you want an easy way to understand if a company is continuing to produce, high growth and high profits, then that Rule of 40 metric is just a very simple add of the two. Now, increasingly, I would say in the US, people also talk about Rule of X, which is all things being equal, investors still want to see that more comes from growth than just an absolute focus on cost. And so I think Rule of 40 is quite popular. Rule of X actually applies an adjusted weighting to the top for growth. And so I think both metrics are quite popular.
You talked about balancing growth and profits. That's like the #1 rule, really, for software companies. But most software companies really struggle with this. You've moved into the profit phase now. How do you strike that balance?
Well, I think, look, first of all, I would say Xero is a very macro-resilient business, and it has a very strong business model. So, our ability to turn profitable is, I would say, a testament to the business model. It's a testament to the loyalty and retentiveness of our product with customers. Every year they buy into it. And so then profitability for us was a question of, A, where is our cost structure maybe not aligned, and where's there room for improvement? And so we took that improvement a couple years ago. And then B, with that very strong gross margin profile and strong business model, you can then, even after you sort of right-size the cost model, think about where you can still dynamically allocate capital.
Are you concerned? I mean, analysts are saying, maintaining revenue growth in a tough macro environment could be difficult.
Yes.
What do you say back to that?
Well, we say that globally we are lucky to participate in a market where SMBs are still digitizing, and so the overall TAM and cloud penetration available to us in the markets we serve is still quite high, meaning we don't believe those markets are saturated for cloud accounting. In fact, quite the opposite in many of the markets in which we participate. And then we would also say, look, we think we have different levers for growth. It's not just about is the TAM available, it's about, what are the available levers in our go-to-market? What is the available levers in our marketing engine? What are the product improvements we can still make? So I think our confidence in our ability to grow is about the opportunity still available to us, both in the macro environment and also in the levers in our business.
Subscriber growth in Australia obviously slowing, still growing, but slowing growth. Is that something that you would expect at this level of penetration? I mean, just talk us through that and whether you'd like to see that turn around.
Well, first of all, I think to your point, we feel quite good about it. I mean, we added over 100,000 subscribers in the half on an underlying basis. Let's just, to your point, imagine and remember that, in fact, Australia has some of the highest cloud penetration in the world. So if you look at it relative to the population of SMBs coming online who are looking for cloud software, which is really the net new kind of number, we feel that that number is quite healthy.
Okay, US, let's talk that story, because it's a fifth of your market share, the US. Subscriber growth there is falling. It's been a bit of a difficult half, I guess you could say. What is your plan or strategy there? Because I'm imagining you want to turn this around. What's your strategy in the US going forward?
Well, again, I think we would characterize our half as quite solid. And the reason I say that is if you think about the US, we're on a journey there to first and foremost improve the product market fit of the product. While it is very loved as a bookkeeping tool, it's had some noticeable gaps that we've wanted to fill. We've talked about bill pay, on our partnership with Bill. We announced that at, I guess, 6 months ago. Yesterday, we announced the partnership with Gusto to embed payroll, which is expected to be in a product like ours. And then at XeroCon Nashville, which is our big customer event just 2 months ago, we announced some big improvements in bank feeds and bank reconciliation to adhere more to US practices. and those opportunities are also coming. So the way we think about it is, look, we'll continue to improve the product. In some ways, we feel like our sales motions actually, relative to a couple of years ago, are probably more healthy. You know, we're selling smaller deals with a bigger chance of customers activating that inventory. We have an increase in confidence in our ability to attribute our direct spend. So we think actually we're making gradual improvement, and we wouldn't call it a turnaround story. I will just note that the U.S. has grown since the day we launched it. And our opportunities keep accelerating momentum.
I can't talk the US without mentioning a new president-elect.
Yes, of course.
Donald Trump. What is sort of your take from a business perspective? He's known to be quite pro-business. Does this change or alter your strategy at all?
It doesn't alter our strategy. I mean, look, what directs our strategy are two things. Number one, our customers, and what they need, and B, you know, the TAM available and how to go get it. The reality is that Xero is a pretty macro-resilient business. I mean, you need accounting software when times are good, but you need it even more when times are bad. So I don't think we look at any administration change as changing what small businesses need to solve for each and every day. Now, of course, you know, there might be extreme events like COVID, which do shut down a country, as an example. Or if economies are kind of in decline, you might have lower small business formations. But again, the bread and butter of our business is small businesses that already exist and those that are moving their business online, looking for software to help improve their efficiency. That trend is not going away.
Looking at the macro environment, as you mentioned, if you've got rates coming down, which we're in a sort of declining rates environment now, do you see businesses having a bit more capex to spend, therefore putting that towards, you know, subscriber growth, a catalyst for subscriber growth going forward?
It could be, but keep in mind, our software has always been pretty affordably priced. It's like $30 a month, $40 a month. So I don't think that's the thing that's stopping growth, to be honest. I think it's about businesses understanding the need to digitize and what role software like accounting software can play in that journey. So I don't think there's a direct correlation between kind of interest rates and the growth of our subscribers. I think it's far more indirect.
There seemed to be a bit of chatter in the market prior to results and the lead up that costs may be an issue, but then obviously your results came out and we saw that costs weren't an issue, and that's probably part of the reason why we saw such a spike in the share price. How did you manage to maintain cost management so well in this environment?
We forecast our OPEX guidance. We provided guidance at the beginning of the year, and we're operating according to that plan.
All right. AI, it's something that is talked about ad nauseum at the moment in the market,
yes,
but it's something obviously that's really important and to your business. So yes, you've announced Jax, obviously. Can you just talk us through your AI strategy going forward and how important it is to Xero?
Sure. So first of all, people need to remember we've had AI long before Gen AI was a buzzword. You know, if you think about, we are a system of record for small businesses. We hold their accounting data. That means we do things like ingest their documents. That involves traditional AI. Oh, we reconcile transactions and match categories. That's also AI. I mean, there is AI throughout our product, right? Oh, by the way, we provide analytics and reporting. That's also AI. So we've long had traditional AI. But as we think about Gen AI, there's no doubt that the era in which we live of agents that can go out and perform tasks for you is game-changing for any software that thinks their job is to make the lives of their customers easier. And we're no exception.
Sukhinder, great to have you on the program. Thanks so much for joining us.
Thank you.